Well, hard assets, inflation protection, and a mispricing. There was a while during the pandemic when they were trading at quite discounts to net asset value. More from fear and more from just the clarity or lack of clarity in the markets. So we focus on the public market, of course, but we look through to the private market, and we continue to see really strong inflationary protection in our leases because we're getting somewhere between 70 to 80% of inflation pass-through in rents. So we're maintaining that rent growth. And we're seeing, of course, in the sectors I mentioned before, strong underlying demand, so rents are going up. So we're going to have a positive cash flow in our companies, in our real estate for the next several years, which I think is very inflationary protective. And there's one added piece. The private equity space in real estate, which I first worked in way back when I started, now has $400 billion of what we call dry powder, unutilized or uninvested capital, and most pension funds around the world continue to add allocation to real estate. So 90% of real estate gets allocated in the private market, 10% goes to the public market, give or take. So where do you think the capital is going to be going? Into the market, which pushes prices or firms prices up for the best real estate sectors. We take that into consideration in our investing. I don't have a full idea of what could happen with stagflation or something that gets really out of hand. But real estate as a hard asset class, inflation protected, on a relative basis, would look better than most asset classes. The reason why we're seeing like technology stocks, some technology stocks get hit so badly so far in 2022, is as the discount rate goes up. What are you discounting? If there's no earnings or no cash flows, those stocks get hit pretty hard. Not the Apples and the Googles, but others. So real estate, because you have that inflationary protection, yeah, there's been some adjustment in pricing, but we continue to think that on a relative basis, you're in a good spot with the dividend plus growth. It really depends on the market cap, the size of the company, and how it's being run. The best companies, we'll use the United States as an example. The best REITs in the US trade at or above private market value because they have excellent management, low gearing, right, tight balance sheets, growth potential internally and development. They do development on their own for the benefit of the shareholders, internally managed, so best-in-class companies. They trade generally at or above, if you will, maybe, NAV. However, there are smaller companies that may have more entrenched management, a bit too much leverage, or they're sort of under the radar screen by many other investors. Those tend to trade at discounts for one reason or another, structural or other. We like to play in that sandbox because we believe that with the capital in the market, they are open game in the safari. And we've seen several opportunities already where companies have been taken private by the big private equity names that everyone knows. And we believe that that will continue. So we have our eyes and ears open and investing not only in the best-in-class companies, but companies with good assets where we think there is a catalyst to get to the fair value, which sometimes can be between 30, 50% discounts. I would say that today being an active portfolio manager was a very good thing to be, mainly because the ETF in global REITs has 250 companies in it, and it's biased toward the large cap names, which tend to be more fully valued. We love those companies, but at the same time, we like to play in the sandbox of the smaller mid-cap companies where they might be more opportunistic in value. It requires you to actually really open the hood and get into the engine to understand it. And a lot of active managers don't really do that. They kind of look at the benchmark and say, we have to be looking at the big names. We tend to think that there's more value and opportunity in those small and mid-cap names. So we play there. And for example, one of our names, for example, might be 3 to 4% of our portfolio being a small to mid-cap name. And that's $1 billion name. It's not a tiny company. It might be 20, 30 basis points of the index. So our ability to create alpha, if you will, by owning small and mid-cap value names in good sectors we think we're in the sweet spot. Just about everything. Geopolitical, inflation, tenant risk, pretty much everything. But I have to say that I've been in this game a long time. I'm not a spring chicken, right? I've been in it for 30 odd years. And I've seen cycles that you wouldn't believe, from the late 80s to the early 2000s to the GFC to COVID. And each time, right, real estate comes out, generally speaking, pretty good. Sectors change, companies change, where you want to be positioned changes. That's our job, right, to figure that out. And the public REITs today have never had stronger balance sheets and better business models than they've had in the history of the REIT industry going back to the 1990s.